The foundation of our business is built on providing long-term financial security to Canadians. What is your view for the future of this foundation based on the pressure being felt by life insurers on pricing guaranteed products?
You're absolutely right. That is a foundation of our business. And what do consumers look for? They're looking for long-term stability, long-term guarantees. So that's what this industry has been built on. And personally, I don't see that changing. We need to focus there. What we've got to do is reflect the market realities. So if you look at it today with the low interest rate environments, what has happened is we've had to reprice products that are today interest rates are lower than when they were priced 4, 5, 10 years ago. So you got to make some adjustments there. So there's value in making some changes to pricing, but the long-term viability of the product still exists. We look at this and we're saying, well, what's the consumer looking for in an insurance company? What are they looking for? And they're looking for either long-term guarantees, either in the form of cash, forms of benefit, whether it's a death benefit, it's a payout annuity, or it's a living benefit type product. And they're looking at it for the long term, and they want some stability there. You look at PAR as an example. Even though low interest rates, one can argue that with PAR, it can almost be identified as a product that's variable in terms of its dividends, where both the company and the client share on the risk and reward through the dividends. So even though interest rates will have an impact to the dividend on the PAR policy, dividends aren't only based on interest rates. You look at the returns from the equity markets, look at returns from real estate that we invest in. There's mortality gains, there's expenses, etc. So it's all a combination. I think the industry will adapt to that and still have strong products for the consumer.
Paul?
Well, I'm possibly a little more negative than Phil, but I think now you've kind of got the perfect storm, right? You've got historically low interest rates that we would have, 20 years ago, who would have imagined we'd have interest rates where they are today. You've got an equity market that is volatile at best. It has created a lot of issues for insurance companies as you've seen in the earnings of certain insurance companies over the last few years and the portfolios of clients. You've got a changing international accounting regime, which could be devastating, may not, but could be. And effectively, I talked to some of the people I've talked to at insurance companies feel that there's sort of the problem they've got is they're learning as they go. So they've learned from all their mistakes, right? They've made a lot of mistakes in pricing, and now they're learning, and so they've had to become a lot more conservative. So I agree with Phil that I don't think at any time you're going to see the insurance industry say we're not going to provide long-term guarantees to clients. But if we continue with interest rates where they are today, those products are going to reflect those interest rates, which are, the prices you see today on level COI don't really reflect today's interest rates. They reflect, maybe a little more positive bump back up. So I think if interest rates stay where they are, we're just going to see higher prices. And ultimately, there's at some point there's some price point where those products may not be as attractive as products that are not guaranteed. So, but I think I do agree with Phil that really I think the thing we have to push as an industry is that we provide long-term financial security. No one else provides that, and we have to do everything we can to protect that.
Considering the fact that Canada is probably the only country in the world that has the level of guarantees in their insurance products, do we tend to be a little naive in assuming that these guarantees are going to continue given recent economic events?
That's a great question. I think if you look at we'll talk a little bit about IFRS and the International Accounting Standards Board, and which really comes out of Europe. And in Europe, they don't have products. They don't have permanent insurance products, really. They have term insurance and equity-linked investments, and so they don't really have the kind of guarantees that we market. They don't understand them. They don't market them. Their consumers don't buy them. And Canada is really we're 3% of the world's GDP, and we're really the United States to a certain extent, we're the only country in the world that really provides these kind of long-term, absolutely guaranteed products. So you could make an argument that that doesn't bode well.
Phil, do you want to comment on that?
Yeah, personally, I don't think it's a real issue per se. When you look at it, like I said, you look at participating insurance. It's been around since the beginning of life insurance industry, and it served the test of time. Clients have been well rewarded. The product has done what it said it was going to do. Both the companies and the clients participate in the gains. There's been improvement in mortality. It's not only interest rate is not the only factor. And we'll deal with the IFRS issue, and that's still a proposal. So the IFRS is still at a proposal stage right now, the second draft of it. And I'll deal with that a little bit later on when we get asked one of the scripted questions.
Well, the next question is scripted, and it's probably something that ties in with the question we just answered, and maybe we've already answered it, but how will the industry be dealing with the low interest rate environment if it continues for a number of years?
I think it comes back to that. If you price your product according to market reality, in my view, you'll be okay. What the issue is when you price a product assuming certain assumptions, and then you don't reflect the reality down the road, it doesn't work anymore. And if you come back, it's to a matching. So if you're matching your assets and your liabilities, and when you invest a dollar at X percent, and you have a debt at X percent, if you keep it to maturity, it's going to do what it's supposed to do. So again, you just have to price it according to market reality. Now, is there pressure on products to see some changes in rates? We've seen it with the level cost of insurance on the universal life. We have made the adjustments because we had to price taking into consideration current rate assumptions. And even the rate that's gone from, there were 2 price increases in the last year, because I see that question coming up, 2 in the past year, but there was a drop in interest rates. And when you're doing this long term, if you assume that you're going to drop of 50 basis points, and you're investing long term on 30 years, well, at 50 basis points, 30 years, that's quite a bit of an impact when you start doing present value. So you have to make the adjustment, and that's what the industry does. The industry, in my view, looks at what the market conditions are, and you price accordingly. You have some products that haven't yet been repriced, and is there pressure on those products? Absolutely, there's pressure on those products.
So I would agree with Phil. And what I see happening from a distribution standpoint, what you see is right now companies they're not exactly pushing their level COI products, right? They're pushing YRT UL products. They're pushing whole life products. Everyone. I remember 20 years ago we used to say term insurance rates can't get lower. Well, we were wrong on that one because they're continuing to be ratcheted down, which is again reflects market reality. So. I think that from an insurer's perspective, from a distribution perspective, looking at insurers, what I see them trying to do is spread out their risk in terms of, they don't mind selling level COI products, but they want to sell, they don't want it to be 60% of their product sales. They want to try to sell more YRT UL, sell some whole life, sell some CI, sell some term insurance. And I think you're going to see companies, the other thing that you're seeing insurance companies now, they're getting out of not that they're getting out of the seg fund business, but they're getting into the mutual fund business. And why are they getting into the mutual fund business? Because you don't need capital reserves. You don't have to set up reserves for guarantees in the mutual fund business. So you're seeing insurance companies trying to push those kind of products out to their distribution as well. So I just think you'll see, in the current environment, you're going to see insurance companies, trying to spread the risk and spread out the kind of products that they market.
Okay, so given this, and Phil, I'll ask you this question then. Paul, do you see a return to adjustable pricing type products?
Well, I think we have to be able to identify what does that really mean. And as I said earlier, one can argue that par is an adjustable type pricing product. The dividends aren't guaranteed. Both the carrier and the client participate in the risk and the reward of the fund. So I think you've got that already, and it's a good seller in Canada. It's stood the test of time from day one. So that's one avenue. If you look at it from a non-par product, is there a potential of a variable product? Again, what does that mean? What will it look like? And what will people be willing to pay for such a product? And it's a bit of a vague answer because the reality is you have to define what that means and where's the risk and how much is a client willing to pay for that variable type product, and the difference between that and a guaranteed product. You're looking at living benefits as an example. there is today guaranteed renewable disability insurance that's being sold. Yet the demand for the non-cancelable policy still exists. The question comes back to where the customers want to go. Critical illness insurance, you've got the 10-year renewable. Can you define that as a variable type pricing? It changes every 10 years. The demand is still to look for the long-term type products. So we're selling, T100 in the CI marketplace as well. So you really have to be able to define it a little more to see what it really means. And again, if you price it in today's environment, take into consideration what the environment is, we'll come up with a product and we'll work with advisors and understand the consumer need, and we're there to meet their needs.
Paul?
Who in the room was selling life insurance in, say, 1979 to 1982? Okay, so that was the birth of adjustable products, and the birth of adjustable products was based on 15 to 20% interest rates. So effectively, what you saw was new money interest rates drove adjustable products. And I don't know, has anyone ever seen an adjustable product that turned out good for the consumer? No, they were awful products. They turned out to be disasters. And so, first of all, let's hope we don't go back to those types of products for that reason. And the second reason is that interest rates then were 15 to, they're now 2%, 2.5%. So if you have an adjustable premium product, it's going to be cheaper, it's going to be more expensive than a guaranteed product or the same price. So, I don't see, from that perspective, and I agree with Phil that really whole life is an adjustable premium product, but it's more to the point, whole life is a product where the client shares some of the risk. And what we've seen in the last 20, 25, 30 years is that the insurance companies, the poor insurance companies with their billions of dollars, they've had to take on all the risk. But they've taken on all the risk, and they've tried to price aggressively, and really advisors and clients have somewhat selected against them on these products because they've got to keep their pencils sharp, and they're taking on the risk, and rules change, and they have to set up more reserves, and I think really we're going back, I think, to the era where the clients will share some of that risk, some of the and if you look at the whole idea of par products, it's based on insurance companies invest in long-term infrastructure, they invest in bonds, they invest in some equities, they invest heavily in real estate, and historically they've been good investors, and they've had very attractive blended rates, and that's reflected in the dividend scales you now see from insurance companies. So I think you're going to see, and we're already seeing it. We're seeing whole life sales in Canada are increasing significantly, and I think we'll see them continue to increase. And many high net worth people see whole life or products like whole life as part of their as an asset class that forms part of their overall portfolio and does certain things for them in terms of their estate and succession planning. So, yeah, but I don't think we'll see adjustable. I hope we don't see adjustable premium products because it didn't work out so well the first time.